The Swiss franc has faced a number of challenges in the last year, and with rumours surfacing of a real estate bubble, these problems show little signs of subsiding. Max Roth from BCV joins me now. Max, thank you very much for joining us in the studio today.
Hello.
Low interest rates were meant to put a lid on the surging franc and slow growth down. However, subsequently, this has caused housing prices to rise 27.5% over the last 5 years. This is indicative of a housing bubble, surely?
Well, I don't think so. We can call it a hotspot or very hot market indeed. But for the bubble, to call it a bubble, you need also a rise in interest rates. And this is missing. So usually to get a bubble, you need a price increase and rising rates. And that's not the case.
The SNB has repeatedly pledged to step in and stem what it believes to be excessive mortgage lending. This follows the OECD's warnings in January that Switzerland needed to rein in credit in order to avoid a housing bubble. Do you think the SNB should intervene?
They are intervening in the markets, asking banks to restrict the growth for mortgage lending. And they talk specifically to each banks and try to pull down this excessive growth. And this is in place indeed.
There are also concerns over loopholes in real estate legislation which facilitate money laundering, with capital going into real estate, which would previously have gone into shares, exacerbating what's already a tense housing market. Do you think that this is a real concern?
Well, I don't think it's a real concern. Well, it's difficult to give numbers, of course, because it's by definition it's difficult. But personally, I don't see a lot of activity by definition, because if I accept this money, I go into jail. So I would be very restrictive on this topic. Well, we must also understand that in Switzerland there are restrictions for investments when people deposit money or do something with their money, and that's not the case in other countries. So if you go to foreign countries, you can invest, deposit money. Nobody is going to ask you any questions. So if you have to hide money, would you choose Switzerland?
Probably not. A report by Credit Suisse anticipates prices to remain relatively stable, claiming that the economic factors to push prices down aren't there at the moment. Do you anticipate a price correction in 2012?
Well, I don't think in 2012, because rates will stay low. Again, the missing ingredient to make a correction in the housing market, it's rising rates. And not only a teeny rise in rates, a substantial rise in rates. So I doubt that in 2012 we are going to see this happen. But clearly this is a threat going forward, maybe 1 or 2 years. Remember, the Fed is talking about raising rates, short rates, maybe in late 2014. Suppose that this will happen and the housing market keeps going up in the meantime in Switzerland, sure, there will come a point where there will trigger a housing market correction. So my best guess is that this will happen if rates on the 10-year Switzerland goes above 2.5%. Then I think the housing market will be in trouble and make a correction.
Max, thank you very much for joining us once again.
Thank you.
We'll be back shortly with more exclusive interviews. For now, though, goodbye.